In this video, we'll talk about 5 things in personal finance that goes against common perception. These are lessons I learned on my journey to educate myself on personal finance topics, and some of these surprised me. I'll link to the full video for each of these lessons where I take a deeper dive. So let's begin. First, let's talk about the FIRE movement. FIRE stands for Financial Independence, Retire Early. It's based on the principle that you would have enough passive income to meet all your financial needs and therefore not need to work, hence the independence part. Whether you want to retire at this point is up to you, but in essence, that's the key aspect of the FIRE movement, that is to be free from having to work and do whatever you want with your free time. While that sounds appealing, the stark reality is that most people can't and won't achieve financial independence. Yes, I know, some personal finance influencers will tell you all you need to do is save a little money every month and let that compound over time and you will get there. But what they don't spell out is that this would usually mean drastic changes to the average person's lifestyle, and that's something many people are not ready to sacrifice. So the lesson here is, don't fool yourself into thinking financial independence is easily achievable with a few tweaks, especially if you are an average earner, because when you crunch the numbers, they simply don't add up. Check the corresponding link in the description to see the numbers. Still on the retirement topic, one of the persistent myths going around is that you can safely withdraw 4% from any portfolio. Now, that couldn't be further from the truth. The 4% rule came to light through the famous Trinity study, whereby different withdrawal rates were simulated using historical data. The results showed that a 4% withdrawal rate actually had a very high success rate, even 100% success rate in some cases, and this gave rise to the famous 4% movement. However, if you look at the study, they picked the S&P 500 as the stock component. The portfolio used a mix of stock and bonds in varying proportions for a retirement period of 30 years. The data used in the study was from 1926 to 1995, during which the stocks returned over 10% and bonds almost 6% on average. Therefore, the problem is that by taking 4% as standard, you're assuming that past performance will repeat itself. And of course, we're talking of the performance of the S&P 500, which may not be what your retirement money is invested in. Furthermore, we haven't really factored in inflation, which means that the 4% will not mean much by the end of the retirement period. Let's talk leverage ETFs. A leverage ETF is an ETF which amplifies its performance using either debt or derivatives. Leverage ETFs are an awful idea in theory, but historically they have performed quite well. When you hear the word leverage, automatically alarm bells should be ringing, because that usually implies taking on higher risk. This higher risk comes from using debt or financial derivatives as mentioned earlier. But there's more. Leverage ETFs usually track the daily returns of the underlying ETF, not the total return. For example, a 3x leverage S&P 500 ETF is meant to multiply the daily returns of the S&P 500, but only for the day, then things sort of reset. If you think they should be the same in the long run, you'd be wrong, because the math doesn't work out that way, and also these leverage ETFs usually have higher fees. So if you search around online, you will probably find many people advising against buying them, and for the reasons mentioned above, they are right. However, if you use actual data to backtest popular leverage ETFs like the S&P 500 and Nasdaq 100, you might be surprised to find that they have performed quite well. And that's predominantly because some markets generally trend upwards. Sure, there have been dips and they wreak havoc to your portfolio value, but they have recovered. Now let's be clear here, I'm not saying you should invest in leverage ETFs, because firstly that would be financial advice, and more importantly is that the conclusion earlier is based on historical data and there's no guarantee that the same trend will repeat itself. So take it as a fun fact instead. Let's talk about bond. Now bonds don't interest me unless they have a yield of at least 7%. Bonds usually have lower volatility, meaning their prices don't fluctuate as much as stocks, but on the downside, their value does not rise nearly as much either. In fact, some bonds are negatively correlated, meaning that when the value of equity falls, some bonds tend to rise in value, thereby offsetting that downfall. And that's great news if you want a portfolio with a smoother value. This is a reason why people tend to incorporate bonds into their portfolio. In fact, in retirement portfolios, it's common practice to include more bonds in the portfolio as you approach retirement, just in case there's a market crash before your retirement and it dips substantially in value. The downside of this strategy is that you limit your portfolio growth and resulting compounding. In fact, there is an argument that can be made that if you invested early enough and with significant lump sums, then you would have generated so much wealth that even after a market crash, you would still be better off than if you kept bonds in your portfolio. Let's take an overly simplistic example to illustrate this. Say your bond and equity portfolio yields 5% per year, but a pure equity portfolio yields 9%. Let's also assume that during a market crash, the mixed portfolio only loses 10% of its value, whereas the pure equity loses 50% of its value. After 30 years, if the market crash happened right on the day of your retirement, you'd still have almost twice as much in your pure equity portfolio than in your mixed portfolio. That's why one might think 100% equity is the way to go. In fact, in one of my videos on a retirement emergency fund, I showed that a full equity portfolio plus a cash reserve would beat an equity and bond portfolio because the cash reserve allows you to ride any stock market crash while having more invested in equity. Let's talk about state pensions. If you're lucky enough to reach retirement age and contributed enough to qualify for state pensions, you may be offered the option to defer your retirement. If you defer retirement, you get a higher pension amount, and this would adjust according to inflation as the government has implemented a triple lock system, meaning pension would go up by at least the higher of 2.5% inflation rate or earnings growth rate. The age at which you can take your pension is currently at 65, rising to 67 in 2028. For every year you defer your pension, you get a 5.8% rise. On a side note, this 5.8%, contrary to popular belief, is not compounded, just relative to the initial value. Still, everything so far sounds great, right? Defer and get a huge increase. Well, here's the trap. If you defer more than a few years, you'll probably die before reaping the benefits of deferring. And we're not talking about the possibility of paying tax on state pension if it exceeds your personal allowance. So, before you decide to defer your state pension, think of how long you have to live and whether you'll really be able to enjoy the extra money, because it might just be a trap. Well, I said 5 lessons, but since you're still watching, here's a bonus one just for you. Let's move from state pensions to private pensions. If you have a private pension and reach retirement age, don't rush out to take the tax-free cash unless you really need it. Now, there are different ways of using your pension pot to generate an income, 2 of which being the flexi-access drawdown, or FAD for short, and the uncrystallized funds pension lump sum, or UFPLUS for short. Now, I'm not going to get into the details of how each works here, but to summarize, FAD allows you to just use the tax-free cash, whereas UFPLUS doesn't. You need to take some taxable cash along with your tax-free cash. The logic here would say that using the tax-free cash first means you would leave more behind in your pension pot, which would result in greater compounding. However, the problem here is that by depleting your tax-free cash early, you forego compounding that could have occurred had you left some behind. Then later down the line, when your withdrawals are fully taxable, you end up paying high taxes, well, because you don't have any tax-free cash to use anymore. So it's basically working the right balance between taking enough of your tax-free cash to maximize compounding, but not too much so that you end up paying more tax further down the line. If this seems a bit confusing, don't worry, I have you covered in a 2-video series explaining what the withdrawal options are and how FAD and OFF+ work under different scenarios. So there you go, these are 6 lessons in personal finance that I learned over the past few years. Some of these surprised me, especially the state pension trap. But what about you? Did you find any of them surprising? Let me know in the comments below. Thank you for watching, and I'll see you next time.